Welcome to Factful Finance, where we dig deep into the financial decisions that could make or break your future. Today, we're exposing the hidden dangers of home equity release, a topic that's getting more risky by the day. You've probably heard a lot about it, but what's going on beneath the surface? Let's talk about why equity release is becoming a ticking time bomb for homeowners, especially retirees who think they're unlocking financial freedom. So here's a thought. What if I told you that by releasing equity from your home, you might be building the perfect storm for your financial future? That's right, what seems like a convenient way to unlock cash could end up costing you dearly in the long run. Let's unpack why interest rates in this market are growing riskier and why you might want to think twice before signing on the dotted line. First things first, equity release is often seen as a safety net for older homeowners. Whether you're looking to pay for care costs, fund home improvements, or simply top up your pension, it seems like an easy option. But there's a massive, often overlooked cost: interest rates. And those rates are on the rise, creating a dangerous scenario for many. Let's break this down. In simple terms, equity release is when you borrow money against the value of your home. And in return, you don't have to make regular repayments. Instead, the loan and the interest is paid off when the house is sold, usually after you pass away or move into long-term care. Sounds convenient, right? However, what you're really doing is locking yourself into a long-term debt with an unpredictable future cost. And here's where it gets concerning. Interest rates on equity release products are climbing, and they're doing so at a faster rate than many anticipated. As of the latest data, average rates are hovering around 5.5%, a sharp increase from the 3% rates many retirees were used to just a few years ago. When the Bank of England raises interest rates, it sends shockwaves through the economy and your equity release deal. Those low initial rates you might have been promised are no longer a guarantee. For example, let's look at Steve, a 68-year-old retiree who decided to take out a £100,000 lifetime mortgage on his home. Back in 2019, his interest rate would have been about 3%, but by 2025, as inflation pressures and rising borrowing costs ramp up, his rate is sitting at 5.5%. Over the years, that initial £100,000 loan could easily spiral to £300,000 or more. Now, Steve's house, worth £350,000, might only leave his children with a small inheritance, and that's assuming the property value doesn't stagnate or decline. What started as a safety net has morphed into a ticking time bomb. But it's not just retirees like Steve who are at risk. Anyone considering releasing equity, especially in the current economic climate, needs to be aware of how interest rates interact with loan balances. Interest compounds over time, and in a rising rate environment, that means your debt could quickly outpace the value of your home. This is a financial death trap for those who aren't fully aware of the risks. Here's the core problem. Many homeowners don't realize the total amount they'll owe when their home is eventually sold. In many cases, they're underestimating how interest accumulates and how it can eat into the value of the home they're trying to protect. This isn't just about the interest rate itself. It's about the compounding effect of that rate over decades. And then there's the issue of housing market volatility. Property values aren't guaranteed to rise, and if the market shifts, you could find yourself in a situation where your loan exceeds the value of your home. This is particularly concerning if you've relied on the belief that your home will always be your ultimate asset, because in the worst case, it might not be enough to cover the growing debt. Let's talk numbers for a moment. If you take out a £50,000 lifetime mortgage at 3% and leave it for 20 years without making repayments, you'll owe about £90,000 by the time it's all paid off. Now, with the new rates creeping up to 5.5%, that £50,000 could balloon to £150,000 in 20 years. That's an extra £100,000 to repay, all due when your house is sold. Here's a shocking statistic for you. According to a study by the Equity Release Council, the total amount of equity released in 2023 was £5.3 billion. That's billion with a B. But here's the thing. Half of the people who took out these plans had no idea how high their final debt would be. When interest rates rise and the economy shifts, that's when the real consequences start to hit. So, what can you do to protect yourself? Know the terms, understand how your interest rate works, and how it might change over time. Many plans offer a fixed rate for a period, but that doesn't mean you're safe forever. Consider alternatives. Before going down the equity release route, have you thought about downsizing, taking out a traditional mortgage, or exploring government benefits that might help with your financial situation? Speak to an advisor. This is a big decision, and you should always consult with a certified financial planner or advisor. They can help you weigh the pros and cons, especially considering your retirement goals and long-term financial stability. At the end of the day, equity release is a powerful tool, but it comes with enormous risks, especially in the face of rising interest rates. The bottom line? It's getting riskier by the day, and it's crucial that you know exactly what you're getting into before signing that contract. Which of these risks resonates most with you? Let me know in the comments. I'd love to hear your thoughts. And if you found this deep dive useful, don't forget to hit that like button and subscribe so you can stay ahead of the curve on all things finance. Remember, this content is for educational purposes only. Always consult a certified financial professional for personalized guidance. If you found this helpful, you'll want to stick around for the next video. Trust me, what's coming next could save you thousands. Click the video on screen to continue your journey towards financial clarity.